Okay, in today's interview, we actually have one of the most fascinating and interesting people that I've come across in my own research into the economic system and particularly into gold and into silver. So today we have Alasdair Macleod. Now, absolutely fascinating individual, and really I say probably I was just wowed by some of your work that I came across. So I want to encourage everyone that is listening here to check out his Twitter link right there down below. Make sure you hit the like button on the right side, the left side right there down below. Leave us a comment so this sends out to more people. Last but not least, just want to thank our show sponsor, Vizsla Resources, one of my favorite silver and gold stocks. So thank you, Vizsla. And thank you, Alasdair, for coming on.
That's my pleasure. Thank you for asking me, Jake.
Okay, so you're a fascinating guy and you're always doing research and you're always critically thinking and analyzing. So tell me right now, when you're looking at the world, the financial system, when you're looking at gold, what's catching your attention right now?
Well, the way they're trashing their currencies. I mean, there are all sorts of lovely little subplots, obviously, but the big story really is the way in which America in particular is destroying the dollar. And that matters for the rest of us. Most other countries are doing it, probably to a lesser extent, actually, than America, to their own currencies. But because the reserve currency for every other currency is the dollar, if the dollar tanks, we all tank. And that's basically where we're going. We're going into a hyperinflation of the quantity of dollars. And that is the most interesting thing. It's something that we've been expecting for really decades. I mean, it was the logical conclusion of the debasement of fiat currency. And now we're actually seeing it, and we can hardly believe it. And it's interesting that you see in the cryptocurrency sphere, I mean, people buying Bitcoin, and they're buying Bitcoin basically because it's limited to 21 million Bitcoins, and that level is going to be hit in the next few years, and it's getting progressively difficult for the miners to produce more Bitcoin and so on and so forth. So it's a relative supply story. And meanwhile, we see the Fed printing. I mean, at the moment, it's $120 billion a month in QE. I reckon that very shortly they're going to have to step that up to closer to $400 billion a month. Now that's, that's some money printing, I can tell you. So, and yet Bitcoin is stuck there. So, but the interesting thing is, if you examine what people are saying, they understand the relative supply story, but actually what they're doing is they're buying Bitcoin out of dollars like it's an investment, looking to take their profit back in dollars. So they haven't actually worked out really what's happening, and that is the dollar's collapsing rather than Bitcoin going up on the argument, if you see what I mean. It's a very, very important distinction to understand. So that's one of the subplots, which is fascinating, and I wait to see what Janet Yellen and Gensler at he's CFTC, I think, what they're going to do about it, because I don't think they like the idea of Bitcoin being a competitor to the dollar. So the danger, I think, for anyone in that market is, they're just assuming that the powers that be, now that you've actually got a government in America, because remember, all this happened in the interregnum between Donald Trump, having lost the election, and Joe Biden actually taking power. I mean, that's only just happened. 20th, he assumed office. The point about things like cryptocurrencies is that there has to be a policy, and they'll be looking at it right now and thinking, what are we going to do with this? What are the dangers it presents us in terms of our policy and all the rest of it? So I would be pretty cautious at this stage. And, as someone who's independent of these things, and I try and stay as independent as possible, it's going to be interesting to see how that one plays out. So, the answer to your question is basically it's the printing of money, the debasement of fiat currencies. That is the number one story. But there are these side plots like what's happening with cryptocurrencies and what's happening with commodity prices. I mean, they're going up. What does that tell you? It tells you that the dollar measured against commodities is going down. So That's another interesting story. What's China doing with it? China is stockpiling. China has obviously taken the view that the dollar is trash and they would rather have commodities. I mean, I'm simplifying, but that basically was a decision they took shortly after the Fed reduced the funds rate down to zero and then said we will do QE for at least 120 billion a month until further notice. It's part of the sort of COVID thing. But the fact is that the underlying economy is in pretty rough shape. And that's something we can probably talk about a little later.
Interesting. So, first of all, I'm not sure if you saw, I was reading an article the other day by the head commodities research at Goldman Sachs, and he said they are now referring to corn as Bitcoin because the price is going so astronomical. So I take it you're in the camp of you're anticipating significant inflation. I had Jim Rickards on pretty recently, and he's in the camp where he says deflation because there's going to be no money velocity. We did just have Gavin Newsom and Gretchen, the psychopath that runs Michigan, both say they're going to open things up. So that should be interesting for money velocity. But where do you fall in that argument of inflation, deflation, money velocity? What are your expectations here in 2021?
Okay. Well, the first thing about deflation, there is no doubt that we face very strong forces to deflate bank credit. And the reason is quite simple. The banks are over-leveraged. And not only are they over-leveraged, but they see their customers, the people they've lent money to, basically going bust as a result of this COVID thing. It's accelerated, if you like, that contractionary phase of bank credit. So to that extent, yes, there is a great deflation force in there. But as we all know, the Fed will not permit deflation. So they will make up for it. They will print as much money as required. And the way in which this comes about is when things like supply chains start failing. And they are failing. I mean, you've only got to look where all the containers are. I mean, they're all in the wrong place. Container rates have shot up because nobody can get hold of the damn things. Supply chains in America total roughly $40 trillion. I mean, we're talking about, manufacturer A provides stock to manufacturer B, provides to C, and all the rest of it. So what you see in terms of GDP is just the final number. That's the final sales value. But all the transactions that go there are a multiple of that. And so we're looking at around about $40 trillion of supply chain. And with them failing, you can see what's got to happen. What has got to happen is the Fed has got to step in and produce as much money as it takes, whether it goes through the government in terms of the government spending, which is actually what's happening at the moment, or whether the Fed helps individual indebted companies to bridge their way through this. I mean, that would be the idea. I know it's nonsense, but anyway, that's what they're trying to do. Then they will do everything they can to stop deflation. And what happens then? The currency ultimately collapses. And that process, when it happens, can happen extremely quickly. And a lot of people they get very, very confused about this sort of deflation, inflation argument. I mean, let me put it this way. Imagine you were in Germany in 1922, 23. What you saw was the purchasing power of your paper mark going down at an accelerating rate. Now, until it came to around about sort of May 1923, the average person in Germany saw this happening, but saw it only from the point of view that prices were rising, rather like the Bitcoin brigade are today. They hadn't actually realized that what's happening was that the currency was going down. Yeah. And if the currency is going down, you then have to ask yourself, when is it going to stop? As soon as you make that judgment, then you begin to get rid of all your currency. I mean, this was called by the Austrian economists the crack-up boom. It's the final boom into goods, because basically you just get rid of every piece of currency you have got. Now, under those circumstances, you saw a combination of hyperinflation and economic collapse. Now, a Keynesian actually doesn't seem to understand that these two things go together. If you have a currency collapsing, then inevitably you're transferring wealth out of from people, the users of that currency, whether they're spenders, consumers, savers, whatever. You're transferring wealth from them into either a borrower who is benefiting from the collapse in the capital value, whatever the interest rate, or indeed the government. And the government uses inflation as a means of raising funds. And that is exactly what's happening in America now. I mean, if you look at all these programs to deal with COVID, the sort of CARES Act and all the other little bits and pieces that have followed, and Biden's current attempt at getting 1.9 trillion recovery from COVID Act going through. We're looking at huge amounts of money. I would say that the amount that's got to be funded between March, when the Fed had to go all in on QE, and let's say 2 or 3 months' time, you're looking at a figure like around about $8 trillion worth of funding in capital markets. Who's going to buy fixed interest treasury bonds on a yield of, the 10%, the 10-year bond is currently yielding 1.04%. Who's going to buy that? The only person who'll buy it is the Fed. And the other problem you've got, of course, is the feedback from a falling currency, which makes things worse. Foreigners own $27 trillion worth of financial assets and cash deposits in dollars, okay? That is roughly 1.4 times US GDP. They are so overweight in dollars. The dollar is beginning to go down. The dollar is, if you like, it's hyperinflating in the monetary sense. What do you do as a foreigner? You get it out. Either that, or you want to see a rate of interest on your dollars, which is considerably higher, which will compensate you for the collapse in the dollar. Now, at the moment, they're not really thinking like that. They're thinking the stock market's going up. We got portfolio investments. Portfolio of investments have increased from something like $6 to $8.6 trillion equivalent for all the foreigners' portfolios. So, this is great stuff. But the moment that stops, you can see that they will sell the dollar, and they'll sell it in increasing quantities. And already they're drawing back from funding the US government. So US Treasury sales are really being restricted increasingly to the offshore insurance industry in the Cayman Islands, for example, similar type funds in Luxembourg. So, the funding of the US government, which in the past has been very much out of recycled dollars, as it were, from the trade deficit, that is now an extra burden for the Fed. So, this is not looking good. That's all I can say, Jake.
Okay, so where do you think it's headed? Do you really you've said a collapse of the dollar, you said a collapse of currency. Do you really think we're there now?
Well, we're getting pretty close to it. Let's look at it another way. The Fed policy with QE has been partly, certainly at the earlier stages, to inflate financial assets. The way it basically worked was that the Fed would encourage, through the commercial banks who actually have accounts, if you like, with the Fed, to get pension funds and insurance companies to sell their bonds to the Fed in return for cash. And then the idea was that cash would be reinvested in the financial markets. And indeed, this is really what has been driving Wall Street up and up and up for the last, I suppose, almost ever since the last financial crisis, since the Lehman crisis. It's been the backbone, if you like, of the bull market. All this cash going in through QE. Now, there is a huge similarity between what the Fed is doing and what John Law did in France exactly 3 centuries ago, because he got control. He became controller of the currency, and at the same time, his bank, which was the Banque Générale, became the central bank and was renamed the Banque Royale. In other words, it was the king's bank, as it were, controlled by him, and he controlled the money. What did he do? He had this venture. He had the Mississippi venture, which basically was a monopoly of overseas trade, France's overseas trade, both imports and exports. He needed to build a new fleet of ships. He needed to raise money to do this. Share issues came forward, but he supported the share issues by printing money to ensure that the prices went up and up and up. So this was the bubble, in effect. It was on the back of printed money. What is the Fed doing? The Fed is doing exactly the same thing. What's the sensible thing for you to do in these circumstances? Well, there's a chap called Richard Cantillon, who many of your viewers will have heard of in a slightly different context, who was an extremely clever man. And the way he played it was not to sell short the Mississippi shares, or shares in, it's shares basically in the Mississippi venture. But he reckoned that the way to do it was to actually short the bubble itself, and the bubble being money. So he shorted the French livre on the London exchange and also the Amsterdam exchange for pounds and for the Dutch currency of the day. So, and what happened was that the price of the Mississippi venture went from a peak in around about February 1720 of about 12,000 livres down to a price of around about 3,000 livres. But the currency went from whatever it was against the pound and and the florins to zero. Zero. That was the way to play it. So the lesson for us today is the Fed is doing exactly the same thing. How do you play it? You short the currency. That is the lesson which foreigners will gradually wake up to, just as they did 300 years ago.
Interesting. So let's talk about that. One of the ways that, I guess, in a non-literal definition of the sense of shorting, one of the ways that many people, are playing that or moving that is from gold and is from silver. So let's talk a little bit about what this means for gold, and maybe first and foremost, your thoughts on the market right now. We had that big run up past 2000. Then we've just been kind of trading sideways for a long time, starting to drive a lot of people insane, and now they're jumping ship for Bitcoin and Tesla stock. But where do you think we're at right now in the market? Why hasn't it moved when all the macro fundamentals are seem to be to its own benefit?
Well, I think if I can just answer that last question first, I think there are two basic reasons why gold hasn't really begun to reflect the fundamentals that I've just described. The first is that people just are not with it. They don't understand what's happening to money. I think someone like Keynes said that not one man in a million understands money. It's still true today. And furthermore, investment managers in the industry have got no concept of money. They really just don't understand it at all. But anyway, we'll pass on that. So that's the first thing. The second thing is that the authorities are determined to keep the price of gold from not rising. Let me put it that way, not rising. If it ran away, that's their nightmare. Why? Because it would expose the weaknesses of their fiat currencies. And this has been the case ever since Nixon came off if you like, the gold standard, such as it was. It was really the Bretton Woods Agreement, which was, a sort of, it was such a tenuous link to gold as to be ridiculous. But anyway, when that actually failed, ever since that failed, the US Treasury has pursued a policy of telling everybody that gold is, nowadays they say a pet rock, but in those days they said the real money now is the dollar. That is it. It's not gold. And they deliberately tried to suppress the price of gold. And they did this by having auctions. And I remember auctions at the time, 300,000 ounces of gold. It doesn't sound a lot now, does it? And in those days, it would probably be something like $50, $60 an ounce. Not a lot in our terms. It was a lot of money then. What happened? The Arabs just bought the lot. So it wasn't very long before the US Treasury stopped doing that. So they become a lot more subtle. What they did was they absorbed all the demand, the obvious demand around the world for gold by fostering paper markets. And that was really the origin of the COMEX contracts, gold contracts. And that now absorbs, a hell of a lot of gold demand. The London bullion market also grew up on the back of using gold, paradoxically, as collateral for a carry trade. And this was the start of the carry trade. And what they did was they would use gold to raise dollars. They would invest those dollars in 6 months bills for a yield of 6 or 7%. The cost of borrowing the gold was something like 1%. So they would take 5% out of the trade. That was the start of the London Bullion Market Association. So, and now, I mean, it is huge. And what it's done is it has absorbed a lot of demand by creating synthetic equivalents. I think it's quite possible that there will be a crisis on that, because we're now seeing not only demand coming through COMEX from sources other than hedge funds, the managed money category. We're seeing what are called the other reportables and the non-reportables. Now, these basically are people who are not driven in the same way as a hedge fund. I mean, the way a hedge fund looks at gold is there's a time to sell dollar, buy gold. And when you do that with a view to selling gold, buying dollar. In other words, they're not looking at, the sort of the economics of the situation. They're just looking at maybe a trend, maybe, sort of short-term weakness in the dollar that they expect. So they will play that a number of ways. I mean, by selling the dollar and buying foreign currency, or selling the dollar and buying gold. So, the market, if you like, is not really a gold market in that sense. But increasingly, you have these other reportables and the non-reportables. And these are everything, I guess, from perhaps central banks to ultra-high net worth individuals, family offices, Asian funds, going in there and using COMEX as a means of acquiring physical bullion, because they stand for delivery. And anecdotally, I understand that the big traders on COMEX are trying desperately to discourage anyone from standing for delivery. And they do this basically by threatening to shut them out of the market. Well, the answer is challenge them. But I think that where we are in the bull market, and I would say that it's not a bull market for gold or silver. That's not the way to look at it. It's actually a bear market for the dollar measured in gold and silver, because what we're talking about all the time is the dollar losing its purchasing power. That's actually what it is, what is reflected in over time in increased prices for gold and silver. So always look at it that way around. And the other thing I would say is that people who regard gold and silver as an investment are making a mistake. Yes, you can use it as an investment, but you miss the point hugely, because actually gold and silver are the people's money. And what you're playing is the difference between the government's money and the people's money. What's your trust in the government money? If your trust in the government money is declining, then move some of your money into the people's money. Have an insurance policy, if you like. Now, what this means is that you don't trade gold like an investment. What you do is you hang on to it and then sleep at night. And it's a very, very different thing from playing it as, say, part of a portfolio. If you want to play gold and silver in investment terms, go and look for interesting mining opportunities. You could even play, buy ETFs. The problem with an ETF is you don't actually have physical ownership of the real stuff. So that, to my mind, is not owning an alternative form of money to fiat currencies. You have to have the physical, and you must regard it as money, not as an investment.
Interesting and excellent. With I guess what you're saying is when you have your physical allocation to your metals, that's your savings that you actually have. You do not go and intend to trade it in 1 to 2 years. But let me ask you, there's a lot of people that are talking about the manipulation in the metals, and they talk about the London Exchange or COMEX. And people are saying, well, the price isn't moving, and it's so manipulated, I'm going to leave and go buy something that's not manipulated. So what is the point in investing your savings into anything that has to do, whether it's specifically in bullion or it's a part of it is a leverage on mining stocks? What is the point in putting your capital into something that is so heavily manipulated that, as you are saying, they are stopping the price from moving?
The point is quite simple. Markets always win in the end, not governments. I mean, so, I mean, that really is the simple answer. If you place all your faith in government money as opposed to gold and silver, then you will be justified if the government runs manages currency responsibly. And by that, I mean, doesn't inflate it. We don't have these things nowadays, but in the good old days, we had a strong Deutschmark, and it wasn't people didn't sort of look at the Deutschmark as the equivalent of gold, or they got all this gold sitting in New York which they can tap at any time. No, the reason the mark was strong was that it was managed responsibly by the Bundesbank, and that's absolutely fine. But where are they now? They've folded into the ECB, which is the biggest crock of rubbish you can possibly imagine. The Japanese yen used to be a good, strong currency. It's still got some of those characteristics. Why? Because the Japanese, individual Japanese tend to be savers. So when the Bank of Japan prints money and does it through the issuance of bonds, for example, then Mrs. Watanabe just sort of takes the money and banks it and doesn't spend it. So that then becomes, it's interesting because that then becomes available for the Japanese corporations to invest in production, producing the things that consumers actually want. So they've actually got real money being invested in production, and they get a return on that money, and they manage to pay it back. And of course, Mrs. Watanabe doesn't then take it out and spend it. She invests it in something else. Compare that with what happens in Europe now, or indeed in America. Savings, no, we don't want to see any savings. That's a drag on consumption. We must stop people saving, reduce the interest rates to the lowest possible level. Oh, and by the way, we got this 2% target in CPI. Well, we'll fix the we'll fiddle the figures. That's all right. We cut back the apparent rate of inflation, and then we can keep interest rates at zero forever. And contrast the two. Which had the stronger economy? The one with the rising currency, Germany, because it was backed by savers, and indeed the case is also in Japan. Admittedly, the stock market took a sort of, if you like, a death-like blow back in what was it, 1992, somewhere around about then. It suddenly collapsed, but. The answer really is, as far as currencies is concerned, we don't have a currency that you can really trust today. You might say that the Chinese yuan is better than most.
You want to know my principle on that? Never trust a communist.
You dropped out. I think that's a very fair comment. In fact, I don't trust any government at all. So, why pick on them? But there isn't really a decent currency anymore. So it's now all in a race to the bottom. And I tell you, the dollar is leading the way. It really is, big time.
So what is the future of gold and silver? What is the end game for gold and silver?
The end game for gold and silver is that you spend it, because it will be money. It will be money again. Now, I think the way it'll come about is it will actually be remonetized in the sense that paper currencies will become gold substitutes again. The reason that will be so is that the way government paper currencies are going, they will be completely valueless. They will lose all their purchasing power unless the central banks and the treasury departments of governments have something to link them to. They will need to do that. And of course, part of the argument that we've been seeing is, cryptocurrencies, central bank digital currencies, in other words, central banks digital currencies. That's all smokescreen, because it's anything that the central banks produce is another version of fiat currency. It's quite simple, unless of course they link it to gold. But I don't think that's anyone's intention, and I haven't seen that in any of the literature that I've read about it coming from the Bank of International Settlements, for example. So I think that the only recourse that a nation will have at the end of the day is to use the failed fiat in circulation as the means of distributing gold. Okay? What I mean by that is that, let's say, if we look at the US dollar, at a figure which might be, say, $500,000 per ounce of gold, they will fix it at that point, because the alternative is they won't be able to pay the police, they won't be able to pay the armed forces, they won't be able to pay anything, they won't even be able to pay the politicians' salaries. So you can see that government, the one thing that will survive is government, but they will do whatever it takes in order to survive. And the only way in which they can survive from the money point of view is to stabilize it by linking it back to gold. So that will happen, but it'll happen at a rate which is very, very far from the current rate. Now, when this is going to happen, I mean, we could argue the toss about, ideas, make forecasts and all the rest of it. It's completely irrelevant, because it'll happen. When it happens is not really the material point. We know that point is getting close. You only have to look at the finances of the US government at the moment and its reliance on money printing, which is accelerating at an alarming rate, to know that the end of the dollar is not all that far away. On timing, I mean, one of the points about the John Law comparison, which I gave you earlier, is that it's the sort of thing where once markets start collapsing, the currency could go extremely rapidly. You could literally wake up one morning sort of having been quite happy with the way your portfolio has been performing, your financial security and all the rest of it. Suddenly there's a crisis, and then you panic. And everybody will panic at the same time. It's quite possible for the currency to collapse in an extremely short period of time. I mean, a week or a month. Not the sort of, what happened in Germany, the final collapse was really from about May 1923 to November 1923, when the paper mark was finally fixed to the gold mark. I mean, sort of fixed at around about, I think it was 1.5 trillion marks to one gold mark. It wasn't actually exchangeable, but I mean, the point was that they managed to do a little bit of a con trick and to stabilize the situation at that point. So I think that it could happen very quickly, because we've got a highly financialized system where things are pretty well instantaneous. And the second thing is that the John Law experience, once that sort of castle of bullishness with equities way up here somewhere, financial assets way up there, when that suddenly reverses, it can happen extremely quickly.
Okay, my other idea is maybe we'll just use Tesla stock as our money. What about that?
That seems to defy gravity, doesn't it?
Okay, so there's some people that argue, they say, well, the government will never, ever, ever, ever do that. But you're saying they're going to be forced to do that. Otherwise, it's going to be a never-ending spiral of worse and worse and worse destabilization that could be essentially like catastrophic in nature. So you're saying they'll have to do that, and the way you believe it looks like is they let you continue to circulate some form of a currency of shit. But then they say, look, we're storing reserves in gold and it's backed by it, but you can't exchange it. That's kind of the same idea as Germany?
No. Well, that's what happened in Germany. But, okay. I mean, the thing about that time was that the dollar acted actually as a gold substitute.
Oh, wow.
And a lot of the economy was actually being run on dollars. It was the poor people who didn't have the dollars who were basically wiped out.
Wow.
I mean, amazingly, and this is a story I love telling, which came from an Austrian writer called Stefan Zweig. He recounted how, for a start, you had Hugo Stinnes, the inflation king, and he ended up owning about a quarter of all industrial production in Germany, which he didn't pay anything for because he borrowed in depreciating marks. And the other example, really on a sort of personal level, is that you could have bought a 6-bedroom house in the swanky part of Berlin in 1923 for $100. That's what happens in an inflation. But the thing is, I mean, at that time, when you had the collapsing European currencies, it was the mark, the Austrian shilling, Polish, I don't know what the currency was then, it eventually became the zloty. And there was another country as well. I mean, there were a number. Russia also, the Russian Shogunets collapsed as well, all around that time. The situation really is that when the currency goes, the only thing you can do when there is no alternative is to crystallize the situation by making your paper currency freely convertible into gold. Now, that means not just saying, okay, we're going to fix the rate at $500,000 per ounce, or whatever it turns out to be. It means actually, having coinage in circulation. So you could go to the bank or one of the central banks, regional central banks, and say, I got this stack of dollars, I want to exchange it for gold. And they must be bound to do it. So what we're talking about is going back to the pre-1933 situation in America, when Roosevelt stopped ownership of gold. Before then, you could walk into any bank and exchange dollar notes for gold coins. That has got to come back. And that coinage, I think, is desperately important. And also, you can use coinage to give you a link between gold and a secondary metal, in this case, silver. And I'm not advocating a bimetallic standard, because anything that works has got to be flexible and determined by the people, not by the government setting fixed rates. But you can easily set an exchange rate between gold and silver such that it is unlikely that there would be a situation where people would be exchanging one for the other. And America has done that in the past, basically by overvaluing silver. And that works. You can do that. And by overvaluing, I mean, you probably have an exchange rate of something like, say, 20 ounces of silver to 1 of gold, rather than the 15.5, which Sir Isaac Newton set. I mean, the reason he set it was that was roughly the market rate at the time. But it became virtually impossible to keep it on a stable basis. So that's the problem, I think, with anything that government does. But what they can do is they can say, we're going to turn our dollars, or we turn our pounds, or we turn our euros, or whatever it is, into a gold substitute, exchangeable into gold coinage. And that is the desperate thing. That is the important thing. That's what we had in Great Britain from 1817. After the Napoleonic Wars, we went on to a gold standard, and that was when the first sovereigns were produced, sovereign coins. And they're still in circulation today, and they're still money today. Of course, they've got a face value of £1, but actually they're worth £340 today.
So I know you're a busy guy, and so a couple last questions. So first, just real quick, so you really believe that will happen? I mean, even a lot of the biggest gold and silver bulls, they don't think there's any possibility, I guess they say, because, that the government won't do it. You feel convinced that they're gonna have to do it.
Well, it's the only practical way out of this dilemma. I think the thing that one has to understand is that when governments start printing money, they can't stop printing money, and they destroy their currencies. That is the outcome. The argument may be, how long is it going to be between now and that final outcome? Do you think it's within 10 years? Do you think it's 50 years? It could be in a matter of months. This is the point I'm trying to make about the comparison with John Law's ramping up of assets. What's the Fed doing? The Fed is ramping up assets by keeping the yield on government bonds at the lowest possible level and doing that by printing money. It's exactly what John Law did way back in 1720. So we got the same thing. And when it goes, it could go extremely quickly. Now, I don't know the moment when it goes. I mean, there are other things you can factor into it. I mean, for example, excuse me, the global banking system is extremely fragile. The Eurozone banks are basically insolvent. Mm-hmm. There are huge debts hidden in the Target 2 settlement system, which incidentally owes the Bundesbank roughly $1 trillion, or 1.2 trillion euros. That is an accident waiting to happen. I look at the performance of the Chinese banks in their stock market, and they're all standing at their lows. And I sort of think, hold on, is this a good thing? And I see, incidentally, a Zero Hedge article today, which I haven't really read, saying that suddenly the repo rates have jumped in China. Yeah, this reminds me of September 2019.
And shortly thereafter, we had a mysterious virus that came in and
I don't know you can quite connect those two events, but there are things there which suggest that the whole system is extremely fragile and could fall over very quickly. And you're mentioning the virus is actually opposite from the point of view of over-leveraged banks who have now got defaulting loans. I mean, people who owe them money are going bankrupt.
So what do you think that will look like? I did read some data kind of as we're wrapping up. I did read some data here the other day. I think it was yesterday or today that was basically, and I forget the math on it now. I'm seeing if I could pull the chart up. Let's see. I don't want to go search through it, but it was something like 20% of all renters in America are behind on rent for an average of $5,600. And this isn't just America. I mean, this is a lot of the world. How do you think that plays out where, and that's not even counting the homeowners. This is just talking renters. I mean, where does these lockdowns and the economic damage it's done to your average individual with how far they're behind, where does this factor in kind of in conclusion, and how do you see that play out?
Well, it factors in with making banks insolvent and needing to be rescued. Either they go bust or they need to be rescued. And everything is interconnected nowadays. So, if you get a bank in Japan or a bank in Britain going under, then a whole load of other banks go with it, and probably the whole system. So governments have to bail them out. And that's the other thing. I mean, if you look at governments in effectively underwriting the whole of their economies through taking out the banks, nationalizing them or giving them guarantees or whatever. I mean, this money printing it's just beyond any imagination. And that's where we are. And there is no end that I can see to this COVID situation. Do you remember in the early days, they were talking about a V-shaped recovery? Yeah. Obviously, you had a hit on the economy from the first wave of COVID, and they're talking about a V-shaped recovery. That then turned into a W-shaped recovery. In other words, you sort of had the first lockdown, they released that, the economy tanked, then there was a recovery, then they locked down again, tanked, and of course they're still hoping that it'll go up afterwards. But, we get third lockdowns, fourth lockdowns. I mean, it's wonderful that we've got, these new vaccines. And that's one good thing that's come out of it. It's stopped governments, just sitting on permissions for vaccines for decades and insisting that it's tested and tested and tested. This has actually broken that system, thank goodness, and that's good for all of us. That's the only good I can see coming out of this. But as to the financial consequences, I mean, just think in terms of an American bank, which is 10 times geared on its balance sheet. If it loses 10% of of the money that's owed to it through its customers going bankrupt, then the bank is bust. It's actually as simple as that. Can they recapitalize? Well, they could recapitalize, but the problem is that almost all the GSIBs, these are the global systemically important banks, their share prices are, their capitalization in the market is less than their balance sheet capitalization. And if you look at some of the banks in the Eurozone, I mean, you're looking at, they're trading at sort of 25 cents on the euro. Really, the markets are already saying these banks are bust. Because 25 cents in the euro for a bank share is just option money. I mean, it really is. It's option money betting on its survival. If it doesn't survive, I just write off 25 cents. That's where we are. So that, I think, is going to be part and parcel of the collapse. The other thing is, of course, interest rates. When the foreigners really start understanding what's happening to the dollar and its purchasing power, their time preference is going to change. They're not going to be prepared to sit on dollars and accept, sort of 10 years, 1%, 1.5%. No, what they're going to want is a far higher rate of return. So the dollar goes down. What happens? The only thing that can happen is that interest rates rise. And rising interest rates does what? It kills all the zombie companies in the US economy. And it also kills the US government, which is increasingly relying on borrowing huge amounts at zero interest rates in order to continue to spend. So that's the other thing that I think will kill the bubble, the overall bubble, as it were. How does gold go through this? I mean, the interesting thing is that people look at gold and say, well, it doesn't yield anything. Well, it does actually. It's only if you've got a physical bar or a coin, it doesn't yield anything. Just the same as if you have, dollar cash, doesn't yield anything. But along the yield curve, yes, it does yield, and that's why you have got lease rates and all the rest of it that apply to gold. The yield is a lot less than on a paper currency, but that is the nature of the difference between the two. Now, having said that, the only way really to kill a gold bull market is to do what Volcker did back in 1980, 81, and that is to jack up prime rates so high that the speculators who are in there, and it's always the speculators who get killed, have no alternative but to go back to dollars. And he did that by raising the Fed funds rate to 19.5%. Can you imagine? Now, would the Fed do that today, do you think? What would happen if they did that? I mean, you can see the situation is different today. There is so much debt around. Admittedly, Volcker was prepared to sacrifice the whole of the savings and loan industry, and that had to be repackaged into Fannies and Freddies and all the rest of it. This time, if they did it, I mean, they would just end everything. I mean, collapse of currencies, collapse of economies, collapse of everything.
So last question here, real quick. Give us your gold and silver price predictions for 2021.
I never do that. All I can tell you is that the dollar will collapse. So,
do you think it'll happen this year, or you're saying eventually?
I think it'll happen this year. But that has to be a matter of opinion based on my researches. Okay, I must admit that. We don't know the future. The future is ours to discover. All I can say is that having researched it, it seems to me very likely that this is going to happen soon. I think it'll happen in 2021. Could well happen early in 2021. So what you could do, I mean, if I turned around and said to you that I think potentially prices of gold and silver will go to infinity measured in dollars, you'd think I was nuts. If on the other hand, I tell you that I think the dollar will collapse, so what that does to gold and silver is to move them towards infinity, then I think you would have a better understanding of where I'm coming from.
All right, that's fair enough. That sounds good to me. Okay, well, thank you so much for joining us, Alasdair. For everyone listening, we'll have the link to his Twitter account in the description right there down below. Please be sure to hit the like button on this side right over there and on this side right over there. We'd love to have Alasdair back on. So please leave your comments and questions down below and be sure to source them. And thank you very much for joining, Alasdair. And it was fun to hear your take and have some laughs too.
That's my pleasure, Jake. Can I just say one thing?
Please.
I do publish articles every Thursday. You find it on goldmoney.com. That's the Gold Money website. You'll find it under research, and it comes out sort of late afternoon Eastern time. So if you want to read my stuff, you can find it there. But also, it does get go through my Twitter account as well.
Well, I'll put the link into your article page on goldmoney.com as well in the description for everyone also.